Silver, let's have a look at it. We saw gold come under pressure today. Silver is down too after its incredible run last year. Let's get more from Lyle Stein, president at Forvest Global Wealth Management. Lyle, thanks very much indeed for joining us. What are your thoughts right now on silver? It's had such a run.
Yeah, silver has caught up to gold. Let's just put it that way. So we started the year at Forvest in our global investment committee discussing the whole precious metals trade. Gold was the star for the last 2 years, but silver and palladium and frankly, even copper have shown much stronger movements in the second half of 2025. And a lot of that, I think, is the two factors. Number one, it's the industrial nature of silver. It's used particularly in photovoltaics. And then number two, it is kind of the high beta play. And that is important because you get the amplitude in the commodity as well as the stock when economies seem to be stronger. But what happened in silver most recently was the January 1st announcement by China that it is now a strategic mineral, and you're going to have to go through the same process to get silver out of China that you're going to do to get rare earth metals out of China. And that throws a real wrinkle into the whole EV photovoltaic world. And so silver's had a heck of a run, and the stocks in particular have gone parabolic, which is always a little bit of a concern for a market going forward.
One stock that I believe you like the look of is Sprott. Of course, they manage money. A lot of it is invested in precious metals. They have ETFs, for example, playing metals. You see decent prospects for SII?
Yeah, we've owned this as sort of a third way into the whole precious metal space. So you can buy the strict bullion, and you can buy the mining of the bullion. You can buy the streamers, or you can buy a company like Sprott, which actually takes a physical position in silver, gold, uranium, platinum, palladium. They have ETFs that hold physical. And so you're getting a leverage play that you don't get in the other names or the other sectors that I mentioned. So unlike a mining company, you don't have operating leverage, but you do get leverage to the fact that investors want to go and own this precious metal, and they can buy the ETFs that Sprott has. So you've got upside coming from the price as well as upside coming from the volume associated with having more holdings of these precious metals in terms of ounces or tons in the Sprott funds. And we kind of like that leverage, and it's been a nice place to get an alternative exposure to the run in precious metals.
On Venezuela, you think that Halliburton, the huge oil services company, and SLB, formerly known as Schlumberger, they could be winners here?
Yeah, this whole Venezuela thing is still in its very early, top of the first inning kind of way to look at it. But when you look at where the money's going to go, I mean, they're talking about having to spend $50 billion almost on an annual basis to get these wells and everything up into production. The good news is a lot of that money goes to Schlumberger, Halliburton, because this is the well service activities that they provide. And at the margin, that is what I think is going to drive the stock. Same thing with a company like Valero, which we actually purchased earlier this week on this particular news, because refining in the Gulf Coast now is a much stronger asset than it had been prior to the Trump administration's move on Mr. Maduro. So, the marginal dollars will now be looking for places in Venezuela where previously they might be looking in the Permian or in, even the oil sands of Canada, for that matter.
Should we be worried here if Venezuela does manage to ramp up production and steal market share? I shouldn't say steal, take market share for heavy oil in the U.S.?
I think you have to think that way. Again, it's a longer term trend, but at the margin, that is a very, very distinct possibility. The traditional spread between West Texas and Canadian Western sedimentary crude is going to get bigger as a result of what's happened. Now, the good news is we don't ship a lot of our oil to the Gulf Coast. The bad news is we do ship some, and the better news is that, again, it'll take time to adjust the refineries, but ultimately we have a new source of crude in the world, which should be a negative for crude pricing in general. Again, who knows what's going to happen with China and Russia, but the fact of the matter is, I think the oil market is a bit disrupted, and the geopolitical activity, I think, was a bit of a shock. And so the question is, at the margin, will Canada, which took our production exports from a quarter of a million barrels to 3 million barrels a day, a big result coming from the slowdown in refining and production out of Venezuela, what's that going to happen? Or what's going to happen going forward? At the margin, we're going to be losers.
You've been looking at U.S. bond yields, the yield on the benchmark holding above 4%. What does that tell you, Lyle?
We come from a discipline that's called cost of capital. And the cost of capital ultimate benchmark is that 10-year Treasury yield. Now, the anticipation of the markets has been it'll fall with inflation, but it hasn't. And the reason the 10-year hasn't fallen as much as you might think is because of all the supply of U.S. paper in particular. Investors want a higher premium, a term premium or a real return, and that's keeping interest rates above 4%, which is competitive now. With a stock yield, S&P yields about 1.25%. You can potentially get a safer, higher yield in bonds than you could on an alternative basis. I'm not saying it's a great spot to be, but 4% is a very competitive yield, and it doesn't want to go down.
There are concerns. I mean, we just had Carl Shamata tell us earlier on the show that America is running wartime style deficits. Will that eventually rise to the top of investors' minds, the endless red ink?
I think it is. It's a slow bleed, so to speak, Andy. It's taking its time, but ultimately you can't run $2 trillion deficits year after year after year without some sort of consequences. And that's what I think the bond market is getting afraid of. At the same time, you've got a president who's asking for interest rates to go to 1%, which is a lot of liquidity into the marketplace, and their fears of inflation, let alone the fears of the higher real interest rate. So you put that all together, I think that's what's got the bond market rethinking its position and ultimately keeping that yield above 4%.
Lyle, thank you very much indeed.
Take care, Andy.
Thanks. Lyle Stein, president at Forvest Global Wealth Management.